Hey, it's Tim and Lisa, and you're listening to the REI Concierge podcast. The REI Concierge helps Americans living abroad find and buy great investment properties in the U.S. From analyzing markets to finding local partners to closing your first deal, we are partnered with you every step of the way. Let's jump into today's episode. Hello and welcome back to another episode of the REI Concierge podcast with Tim and Lisa. We are really excited to be joined today by Brandon Hall, who is the founder of a firm called the Real Estate CPA. And just for a little bit of background, a lot of our listeners know and are familiar with Tanya Salseth. Tanya was the one that introduced me over a year ago to Brandon's firm. And I have been a client of the Real Estate CPA Firm. And Brandon, we are so excited to have you. And there's a lot of questions that come up clearly about taxes and real estate and things like that. So we are looking forward to jumping into our conversation with you.
Yeah, appreciate you having me on the podcast. I'm excited to do this.
And I will also say really quickly, we'll link all this in the show notes, but Brandon has his own podcast. So many incredible resources that you guys put out from the Real Estate CPA Firm. So we are going to be really happy to share those with our listeners as well.
Thanks. I appreciate that.
So Brandon, let's welcome, first of all, it's good to finally meet you in person. I've heard a lot in person. By in person, I obviously mean on a video call, as is most meetings done nowadays. But I've heard a lot about you from Lisa and just the work she's done with you guys, as well as, with Tanya and other folks. So we always like to start with kind of our guest's personal journey. So why, did you start, what came first, the CPA or the real estate? Were you a real estate investor and then said, I need to figure out how to do these, get these tax advantages? Or were you a CPA and said, oh, all my clients are real estate investors. Maybe I should get into that. I'm always interested to hear about that.
Yeah, good question. Good question. So I graduated from college. I had audited a real estate class, a real estate investing class. That was like a graduate level class. So audit means just sat in on it, couldn't actually participate because I was an undergrad. But the guy teaching that class is like easily the smartest real estate investor that I've ever met in my life. Just all the financial modeling that went on in that class was crazy. So that kind of piqued my interest. Then I graduated college. I went to work for PricewaterhouseCoopers as a consultant, and then moved over to Ernst & Young also as a consultant, doing like government consulting, that type of thing. And throughout that time period at the Big Four, kind of realized I didn't want to stay for 20 years to make a partner. I didn't feel like my opinions were being heard, or that people really cared about what I had to say about whatever was going on projects and things like that. So I started looking for alternative ways to create income, and found real estate again. So I'd taken that course, but found it again. My parents had also around the same time started investing in real estate themselves. So I was able to ask them a bunch of questions and kind of get a good idea of what that looks like. But yeah, I bought a property, a 3-unit property, while I was still at Ernst & Young, and I was super excited about it. It was cash flowing like $700 a month, something like that. So it was good. It was a great return. I still have the property today, and it like on the original cash on cash, it's like a 25% return. But now the equity's built up so much that it's like 5 or 6%. But that property haunts me though, even today, because I can't go and buy another property because that one's like, I've anchored myself to that return. And so now anything in today's market, I just can't, but anyway, still have that property today. It's done really well. But that kind of gave me the bug. And through that process of buying my own real estate, I got on BiggerPockets.com and was asking a bunch of questions there. And then I noticed that people were asking tax and accounting questions. So I started answering the tax and accounting questions because I was studying for my CPA. So all this like timing stuff was kind of working out. There weren't a whole lot of CPAs on BiggerPockets at the time. Now there are. So I don't think the same strategy would work again. But at the time, it was like me and 2 other people jumping in there, and I would set up all my keyword alerts to make sure I was the first one that answered questions, that type of thing. But I got addicted to that because at the corporate job, I wasn't getting any like positive feedback or really any feedback at all. But then on BiggerPockets, you would answer a question and immediately get a thank you, you rock, you're amazing. And I was like, man, I like this. So so I kept doing that, and it was a while, but I think it was like a period of 6 months or so. Somebody finally reached out and was like, are you taking on clients? And I was like, well, I've always wanted to be a business owner. didn't really want to run a CPA firm because I know it's incredibly hard to scale and I don't really want to do tax season and all that jazz. But I was like, you know what, whatever, let's give this a shot. Let's see where this goes. So I said, yeah. And then I started taking on a lot of clients from BiggerPockets and enough to leave the Ernst & Young job and open up the Real Estate CPA and run this full time. So now we have 21 total staff. And that was back I started the firm, officially moved into the firm end of 2016. So now we have 21 total staff. We're adding 8 more by the end of this year.
Wow.
And we work with about 700 real estate investors across the United States. So providing all sorts of tax planning, tax accounting, and just kind of business consulting services.
Wow. So we can go in a million different directions, but I want to stay there for 1 second.
Sure.
How, just for like our entrepreneurial minded listeners, what was the impetus where you're just like, this is kind of cool, but I have no future security in terms of starting my own company. I don't really want to do tax. So all those reasons you just said why you don't want to start your own CPA firm, what made you say, let's do it anyway? Like, was there one thing, or was it like, let's just try this, and if it works, it works. If not, we'll figure something else out. Like, that's always fascinating to me.
Well, for me, I'd always wanted to run a business. So in college, I'd experimented like with t-shirt shops and random things like that, and made very little money, and in other areas made a little bit of money. But now I was like, all right, I want to run a business. I've got experience in the corporate world. I know that I don't like this. I don't like bosses of me. I just think that I can do it better and faster and more creatively. Sure. And back then I was naive, and looking back on myself, like I probably wouldn't hire myself, but now that I've got the experience, I fully believe that was the best move. But yeah, no, I just, I'm pretty risk tolerant. Okay. I viewed it as a CPA firm. So I knew I wanted to run a business. I wasn't sure about a CPA firm because I was like, again, the scale piece, like I wanted to do something big. Anything that I did, I wanted to be big. I wanted to change the industry, and I couldn't really figure out how that worked with a CPA firm. Everybody that I talked to that was running CPA firms was like, oh, it's such a pain, and you grow at 2%, 5% per year, and the industry average is like 6% per year. So it's not growth to get excited about. But I was building the firm on the side while also working at the Big Four, and I was building it really fast. And so I was like, well, the monetary risk is gone because it essentially replaced my income. So then the real risk is just in 10 years, where is this thing going to be compared to where could I be at like Ernst & Young? Could I be on my way to partnership or something at Ernst & Young? And, you make 300, 400, 500K a year if you're in that type of realm. So the monetary risk was big for me to try to figure out, but I just kind of believed that, I was onto something unique that not a lot of other CPAs were really looking at the time, and that I could just kind of get in like with a good brand building sort of marketing campaign, and just become the real estate CPA in the space, and just keep pushing that really hard. So I made a commitment to myself that I was going to try to hire people smarter than me in tax to get the job done, and that I would be the one that focuses on the branding and the marketing and the scaling. And that commitment, holds up for half the year, and then it plummets the other half of the year when I have to get involved in tax preparation. But for the most part, that's what we've done, and we are on a mission to change the industry. We're doing it in 2 ways. One, we're going to be we are I shouldn't say we are going to be. We are a remote firm, so we want to build the model, the blueprint, for other firms to look at and say, oh, that's how you run a remote firm. And 2, we haven't done a great job of this, but this is why we're hiring 8 people. We're trying to focus in on creating a people first organization. So, our belief is that if our employees love working here, all of our clients are going to have great experiences too. So we're trying to really invest in 2022 in our people, get them the appropriate support that they need, get them the appropriate training that they need. And ultimately, that's what we're trying to do, is build the model firm for the industry in the future. So we want firms in the future to be able to look at our firm and say, that's how you run a firm. And that's the goal. That's the mission. So it's kind of become like bigger than me, which is really cool. But I remember my dad calling me up because I was talking to him about, I was like, I'm going to jump ship. I'm going to leave Ernst & Young and do this business full time. Like, I've got the cash flow. I was house hacking at that point. I'd bought another property, a 3-unit. So I was house hacking one. So I didn't have any expenses. I was like, I'm going to do this
Nice.
My dad was like, well, what about health insurance? It's like, dude, health insurance is the least of my worries. I'm 25 years old. I'm healthy. I run all the time. Like, I'm worried about like, am I going to be able to eat next month? Like,
Dads love the health insurance question. Like nothing else matters. What about health insurance, son? Yeah, no, I've gotten that question multiple times myself. That's so funny. But I like Brandon, I like your mindset. So it's kind of like the whole like Cal Newport, so good they can't ignore you thing, where it's just like, hey, average isn't good enough. Like if you want to really change the industry, you have to be the guy or girl. And you were the guy on BiggerPockets for a while in terms of CPA questions. So it's like, I think if you have that niche and like that forte where you're the best at what you do in a specific niche, you can just run with that. And the sky's the limit. So I love that. And another thing that kind of parallels real estate investors, and I'll let you talk because no one wants to hear me, but another thing that kind of parallels real estate investors is you said the monetary risk was gone. You know what I mean? Like the money you were making on the real estate CPA or whatever you guys were called at that time, kind of surpassed your salary at Ernst & Young. So that was kind of like a huge cushion, you know what I mean? And a lot of real estate investors some real estate investors think this is the best thing ever. I bought a triplex. I'm making $700 a month. Time to quit my job. And we kind of like, with our clients, Lisa and I are like, whoa, how are you ever going to get a loan again? That's $700 a month. Do you like food? Like you can't do that yet. So I think that taking the monetary risk out of the equation for real estate investing is kind of like a good analogy there, where you get a couple properties, maybe you get a couple grand in real estate, just passive cash flow where you can quit that job and live a very basic life. Then you can really get big if that's what you want, and it's not one size fits all, it's slow and steady for a lot of people, sky's the limit for other people. But I think taking out that monetary risk is a huge impetus for people to kind of take that next level. So I appreciate you pointing that out.
Yeah. Well, it's important too, because I think there are very few people that are actually willing to, do the couch surfing while they build their dream. And I was not one of those people, right? So I was not going to give up being able to go to a nice restaurant and do things like that, or give up my latte. That's the classic, give up your $2 latte. I'm not going to do that. Right. So how can I build a business and enjoy life at the same time, and not take that significant of a risk? And for me, the answer was, well, I still have my W-2 wage, right? So I'm going to use that to go acquire another property. I'm going to put as little down as I can. It's going to be multiple units. I'll live in one of the units, rent out the other units. And that's exactly what I did. My girlfriend at the time, who's now my wife, I charged her rent. So, I'm like, dude, I'm trying to reduce my risk. That's right.
Business first, have a
job.
Honey.
I don't have a job. You're paying rent. That's the way it works.
You knew it was true love when she stayed around.
She stuck around. I don't know why, but she stuck it out. But yeah, no, it's just I was really looking at anything that I could do to reduce my monetary risk so that I could just focus on building. And there were things that I did in the business at the time too that reduced it. Like I would take somebody's, their annual planning fee and their annual tax preparation fee. I would take that and I would divide it by 12 and I would charge them monthly instead of like getting these like, installment payments throughout the year. And we don't do that anymore because we don't need to do that anymore. And I think that it actually doesn't really align that well with the client interest anyway. But at the time, that's what I needed to reduce the risk. That's something that I did. But yeah, I focused on the branding. I focused on the marketing. I focused on learning as much as I could about tax. I was reading every tax court case. I was reading through the regulations and the tax code so that I can understand it. I made a lot of mistakes. There and what I've learned is that, if you're going to build a business, you can deliver a pretty solid client experience when it's you and a handful of other people. But when you start scaling up, when you start adding people, when you get to 10, 15, 20 people, it becomes your personal inputs do not impact the client experience as much unless you focus on the right inputs, right? And that has taken us a long time to figure out. So if any of our clients are listening to this, they're probably nodding along like, yeah, like it was great for 2 years and then it sucked for 1 year. It's like, so now we're recognizing that we're going, all right, we need to focus on the right inputs. We need to focus on getting everybody else in our firm to the level that we are at. And that's again, doing the investment in the training, where we've got mentor programs going on in the firm now, trying to help coach them on the entrepreneurial side of it, the real estate side of it, so they can understand from an investor perspective what it looks like But yeah, that was something that I have unfortunately learned, is that, you can provide great client experience, and then client experience dips as you scale. And then you try to figure out, all right, how do we get it back up? And then you get it back up, and then it dips again. But every time that it dips, it's because there's a people problem in the firm. And that people problem is ultimately my fault, right? It's up to me to figure out, okay, well, how do we prevent this, or how do we get our people to be top tier, right? I want everybody to be the Brandons of the world, knowing the code citations, knowing the tax court citations, being able to really help a client like understand that we're their coach, we're the guide, and we're going to help them, through whatever it is that they're focused on. So yeah.
So speaking of that, tell us more about the Real Estate CPA Firm, because I think a lot of people, when they think about a CPA, they think about filing taxes in the spring, and you guys do way, way, way more than that. So tell us a little bit about the spectrum of services that you provide.
Yeah, great question, and great topic. So we provide tax planning services. We always provide tax planning services to every client. It's an annual thing, so you can't just come and use us for tax prep. There's got to be some tax planning component there. But we do tax planning, we do tax prep, and then we do accounting services. So we'll take over your bookkeeping, or especially if you're like a larger syndicate or fund, we'll do full service accounting, report to your investors, and all that jazz too. But for most individual landlord type clients, it's a lot of education. So people come to us with a lot of preconceived notions, right? They go on BiggerPockets, they've been in various networking groups and things like that, and they hear about somebody being able to use their rental losses to wipe out their W-2 income. And then they come to us and they're like, this is what I want to do. And so a lot of what we do is educating on, well, here's what you can do and how you can do it and why you can't do it that way. So we really pride ourselves with telling people what they need to hear rather than what they want to hear, because a lot of people want to hear that I don't have to pay any tax, right? but when you get into an audit, you'll realize that you wish that your CPA told you what you needed to hear to win the audit that you're currently facing. And so that's what we focus on. And we do that through this upfront tax planning. We do a 12-month stint. So we do first 12 months, and then every 12 months after that. But we develop a plan for people, for our clients. We have multiple calls that we hold with them every single year. And then we do tax preparation annually every single year too. And one thing that I'm really excited about for next year, actually, Lisa, I don't know how much you've experienced since you're a relatively new client, but next year we are, and we've already kind of started that process. We've got a one advisor point of contact that's going to carry the client through the entire process, including tax preparation. So in the past, we experienced a lot of friction when, like, if Lisa, you came on board and who are you working with?
If where you're going is changing who I was working with, yes, that happened to me, and it was a little unnerving.
Okay, so that's exactly what we want to avoid going forward then. So that's what we're changing. But let's say that you were working with like Blake or something. So Blake would be your advisor, and you would stick with Blake through the entire process. And then even during tax preparation, Blake would still be the guy that you're interacting with. You would get like questions about missing documents from the tax team, but Blake would hold like your debrief call and things like that. So we're really trying to build a more client-centric approach to relationship building and to tax planning. But to answer your question, we do the upfront tax planning, we do it annually, and then we do tax preparation annually as well for almost all of our clients. And then we do bookkeeping and accounting for a subset.
I appreciate the model that you're going towards.
Yeah.
I'd be a cheerleader of that. One of the things that strikes me, Brandon, as I'm listening to you talk, is there might be some questions from our listeners. A lot of our listening audience are newer in the real estate investing world. And there's a lot of people who get their first couple investment properties. They're doing their taxes on their own, and they can use TurboTax and this and that. Okay, well, now I have an investment property. I can plug and play all these numbers. But after a while, it starts to get a little bit more complex. And the question that comes up for some of our clients is, when do I need to look to work with some sort of real estate CPA firm? When do I need to make, or even just move to a CPA? Like, some people, again, are still doing their own taxes. And what is sort of the threshold that you look at with clients? Like if somebody comes to you and wants to, engage your services and they have one investment property, great. But I would imagine the vast majority of your clients have more than one investment property. Yeah. So where is it if people are questioning that they really need that sort of expertise and tax planning and other services that you provide?
Yeah. Well, one part of the conversation is cost. Right. So we have figured out, in order to deliver the model that I just described, this high touch client experience, we have to charge $4,000 a year at a bare minimum for every single client between tax preparation and planning. So we can't have somebody that just has a $1,500 tax return as a client. We're not going to service that client well. Work. And we had 280 of those clients that had around $1,500 tax returns. So one of the reasons that our client experience has dropped, that we have determined, is that we have a bunch of clients that are just paying us for annual tax prep. And it's very difficult to understand somebody's situation if you're just seeing them once a year. And that was something that I preached 6 years ago, when I started the firm. And so now we're here, right? And that's like the downside of scale. It's like sometimes you make these decisions that are cumulative and add up over time. And then you're looking back like, how did we even get here? So we've realized, hey, we got to have at least a $4,000 spend. And they have to have some sort of planning and tax preparation if we're really going to service them well. And if we want to do that high touch client experience. So that would be the first thing that I would ask somebody is, hey, if you have one rental property and you want to spend $4,000, then cool, we can help you. It's going to be very educational because there's probably not a lot of technical stuff that we need to do with one rental property, but we can get your mind going and thinking for every future acquisition, and you'll be ahead of the curve. But you're going to be paying for it up front, and it might not be worth. You're probably not going to see the benefit of that for a number of years. That's the downside. But if you're the type of person that wants to get ahead of the curve, then that might be a perfect fit for you. So the first part of it's really just cost. The second part of it is going to be, what is your comfort level with taxation? I mean, we work with investors that have no clue. And then we work with investors that are really sophisticated. So it kind of just depends on what your sophistication level is and how much reading you want to do on your own. And, if you are looking at a tax court case, which very few people do, but if you are, do you understand it relatively, or could you read a couple to try to understand it? And if you're not willing to do those things, then what you're doing is you're basically outsourcing that work to your CPA. And so then the next question becomes, is your CPA willing to do those things? Or does your CPA have the competency to do those things? And if they don't, you should be looking for some alternative solution. It doesn't necessarily need to be working with a real estate CPA, because again, it's going to be costly. But you need to be looking for some sort of solution. And we actually we have a Facebook group called Tax Smart Investors. If you go to facebook.com/groups/Tax Smart Investors, there's like 4,400 people or 4,600 people in there now. And that's our answer to basically saying, hey, my personal goal is to help every single landlord in the United States learn about taxes, because I think that there's a lot of CPAs that will not study on their own. They won't do the extra research, and they're setting their clients up to fail. And at the end of the day, you're the one signing your tax return. So you have the ultimate accountability. So if your CPA isn't going to do it, then you have to do it. You have to learn about taxes. So we created this free Facebook group, and there's some other things in there, but we created this free Facebook group to basically help people answer these tax questions and hold their CPAs accountable, because you don't necessarily need a real estate CPA if you can learn the citations, if you can learn the general theory, because then you can have a better conversation with your own CPA on these topics and on how you should approach them. And when your CPA says things like, yeah, your rental losses from one rental don't offset the rental income from another rental, you will have learned, or if you've done some self-study, you'll learn that, well, I need to ask my CPA to prepare a Form 8582, because when the CPA prepares that, they will realize that everything does offset. So you have to learn how to hold your CPA accountable, or if you're not willing to learn how to hold your CPA accountable, you have to go find a CPA that knows all this stuff, that's going to do it for you, and you have to be willing to pay whatever that cost is going to be.
Why are there so few well, this is how it seems anyway. It seems like there are very few CPAs who are well versed in real estate tax code. Why is that true? And if so, why is that?
That is true. I think that there's a general preconceived notion in the real estate space or in the tax space that there's not a lot of money to be made by servicing middle market clients or individual clients. So you see the large firms who have the top tier talent. Who do they go after? They go after the huge funds. So they're servicing real estate funds. They're servicing people who make $20 million a year, right? Now, those people are not the ones that are in all of our groups online. They're not the ones that are talking on BiggerPockets and things like that. So now you have this kind of this black hole of, and it's a massive need, but there's that notion of like, well, that's not how you go and make money. And I think that it's taken our firm a lot of time to figure out. I mean, there's definitely money to be made, but it's taken a lot of time to figure out how to systematize it in a way that you can always deliver a good client experience. You can always deliver high quality because the top tier talent is going to work for the big four firms that are landing those massive real estate clients. So they're out there. They're just not focused on this space. And that's a big problem. And the people that are focused on this space, I mean, I see it all the time. They'll say things and they don't fully understand Section 469 and how the passive activity loss rules work. They'll say things like, yeah, you can study for your real estate license exam and it'll qualify for real estate professional status. And now you just add so much confusion because that person hears that, and then they go on BiggerPockets and they put, oh, this is what you can do. Now 15 more people hear it, and then they go share it with their friends. And now you just created this snowball of bad information. So yeah, it's a challenging space. It really is. And it's really just the talent, the top talent wants to go and work for the big guys.
That makes sense.
Yeah, Brandon, so the folks at home can't see this because again, it's an audio format and I do this all the time, but I'm sitting here shaking my head, like slowly rubbing out a headache because Brandon's giving me too much to think about, because like everything you just said is stuff I don't want to learn because I have a CPA that's supposed to know this stuff, right? But then I go to my CPA, and I'm not going to say his name, but like I want to invest in a flip with my self-directed IRA, and he freaks out. He's like, Tim, you got to read all the codes, blah, blah, blah. I'm like, dude, I don't want to read any codes. That's why I pay you to know if I can or cannot do this. I know a lot of people that are doing this as we speak, and I know that I can, and I know it's fine, but why are you freaking out on me? So like, yes, Brandon, yes, everything you're saying, yes. Like this, Lisa and I need to be served by folks like you because we don't make $20 million a year, but we also don't want to read anything about tax codes or do court cases because we have other jobs. So God bless you and everything you're doing. I'm just like, you're saying all these form names and like, I'm like, do I need to do that? Do I need to educate my CPA? Like, I feel like you shouldn't have to educate your CPA. I'm gonna get on a box here, a soapbox. So I need to stop before I really get going, because like, what do I pay you for if I'm telling you how to do stuff, right?
Brandon, I think you have a new client. By the end of this call, Tim will be your new client.
Happy to chat.
You're freaking me out. I don't know about all this like real estate professional status and all that stuff. Like, is he supposed to be doing that for me? So Brandon, let's talk a little more specifics. People are sick of hearing me whining. Let's talk about things that apply to our listeners. First and foremost on my mind, and I know a lot of people's minds, and you don't have a crystal ball, I'm not going to hold you to anything, the 1031 debate in the Biden administration. What's the deal? So first of all, if you don't mind, from a tax perspective, tell people, from a professional CPA standpoint, just explain the 1031. I think people who listen understand that. So explain that if you wouldn't mind, and then just kind of see, what do you see happening? Again, not holding you to anything, obviously.
Yeah. So 1031 exchange, think back to when you were playing Monopoly as a kid. You would get the 4 greenhouses and then you would change that up for one big red hotel. That is in effect a 1031 exchange. Yeah. So you're trading houses for the next bigger house. Now, from a tax perspective, what it means is you get to roll over all of your gain into the next property as well. So if I buy a property right now for $100,000 and later it's worth $200,000, I can either sell it and pay tax on the capital gain of $100K, or I can sell it, but 1031 exchange it and essentially roll the gains into the next property. So I don't pay tax on them today. Now the next property might be worth $300,000, but because I rolled a $100K gain into it, my basis is $200,000. So I own a $300,000 property that I paid $300,000 for, but my basis is $200,000. So if I turned right around and sold it, I would have that $100,000 capital gain that I would have to pay at the end of the day. So that's what a 1031 exchange does. It just defers your capital gain recognition. You can defer depreciation recapture as well. A lot of people forget that, if I buy a property for 100K and I depreciate it for $40,000, my adjusted basis is 60. If I then sell it for 100K, so no appreciation at all, a lot of people think I've got no gain, but that's not true. Your adjusted basis is $60,000. So you have a $40,000 gain because of that depreciation that you claimed. And that's depreciation recapture. So you have to pay tax on that. You can roll that forward in a 1031 exchange as well. So 1031 exchange just allows you to defer any sort of gain recognition. At the beginning of the year, the Biden administration came out with a plan, Build Back Better. And part of the plan was to reduce or eliminate the 1031 exchange. They had reduced it with some caps that I've subsequently forgotten what they were. Sure. But that provision or that proposal did not show up in the September budget reconciliation bill that was proposed, and the budget reconciliation proposed last week. So they updated it and re-proposed it last week because there's a lot of Democratic infighting right now, and they can't decide what they want. And they all have veto power. Every single one of them has veto power. So they have to try to find some middle ground. Sure. So they re-released a new framework last week, and it was the 1031 exchange was also not in that framework either. So my crystal ball says 1031 exchanges are safe. I think long-term capital gain increases, those are not going to happen. I don't think that the stepped-up basis issues are going to happen. I don't think that any of the retroactive taxes are going to happen, like the syndicated conservation easements going back to 2016 being disallowed. I don't think that's going to happen anymore. I don't think that the IRA, taking your self-directed IRA and investing in syndications and having to claw all that back, because that was proposed in the September bill. Wow. Yeah, that's not in last week's bill. So okay. I think last week's bill is pretty vanilla. Pretty like the biggest thing in last week's bill, assuming that it gets passed, of course, is that the IRS is going to get like $45 billion of money specifically for enforcement. And so you can expect audits to increase over the coming years. But other than that, not a whole lot in the bill that was proposed last week. So a lot of those provisions have been stripped out and eliminated.
That's good to know.
Yeah.
Yeah. Because the 1031 exchange, and we talk about that, we produce a lot of content, blogs and podcasts, obviously, and stuff like that. And 1031 exchange comes up a lot because it's such a powerful tool for people to grow their portfolio, not necessarily get started. But there comes a point in, investor's career, and Lisa and I are probably there, where it's like, okay, everything's cool. You know what I mean? But then if you look back at your properties, there's so much equity just sitting there. And you don't want to sell. I mean, you can sell, but you want to, avoid that capital gains tax and, the depreciation recapture and stuff like that. So to be able to roll it into like a smaller multifamily or even like a small commercial space, like a 10-unit building, that's something that most people can't just afford out of pocket. But you can, if you had a single family home in DC for 10 years and it's appreciated $400,000, you can most certainly roll that into a small apartment building. So it really allows small investors like us to get into that bigger space, or just, wider space, depending on however you want to strategize. So I know that, it's been a huge point of contention, I guess, amongst the real estate investor community. Is this going away? Should I not do this because of this? And should I do this because of this? And I think I just want to highlight that real estate, in my opinion, and probably Lisa's too, is almost always a good investment. You can't possibly see the future. Who knows what next month's bill is going to be, or next year's bill is going to be, or next administration is going to be. If the 1031 exchange goes away, real estate's still a good investment. Yeah. It's going to be a little bit harder to upgrade. You know what I mean? But I kind of wanted to highlight that there's no reason to wait on buying real estate because of policy agendas. And I'm not by any means trying to get political here. I just, if the 1031 exchange was something that was holding you back from investing in real estate, probably go ahead and do it and not wait on something like that to maybe go away.
Well, and on the flip side, if you own real estate, you shouldn't be liquidating real estate based on a proposed bill either.
Yes. Thank you.
Yeah, I mean, we had all those tax provisions, right? Of the 1031 exchanges being eliminated, of long-term capital gains going to 39.6% instead of 20%. Yeah. And in the September bill, none of that was in there. The long-term capital gains were at 25%. So they did increase them by 5 percentage points, but not at the top marginal rate. And then the 1031 exchanges weren't in there. And I know somebody that liquidated their property because they wanted to capture today's long-term capital gain rates. And what was funny is that in the September bill, the long-term capital gain rate increase was retroactive to April when Biden made the announcement about the long-term capital gain. And so this person sold thinking that they were going to get a 20% cap gain. But then per that bill would have had a 25% cap gain. And now in last week's updated bill, it's not even in there at all. So now they've sold their property and now they've got a tax consequence, but they made a decision based on like these phantom tax changes that aren't actually going to happen.
Phantom tax changes. I like that. Yeah, that they might, but they're just kind of like specters out there that, freak people out. Like, who knows? I don't know if it's coming.
We always tell people, just chill, just chill.
Just chill.
We'll tell you. We'll tell you if it's going to happen, but just chill.
Yeah. If it's real, we'll let you know. Yeah.
Speaking of chilling or not chilling, when you mention the increase in audits that would be expected, my immediate reaction is to feel anxiety and worry and stress. And I've never been audited.
Not chill.
But just the idea of it freaks me out.
Yeah.
So can you talk a little bit about audits? If we do get audited, what does that process look like? Do we need to be freaked out and worried and anxious about that, or can we chill about that too?
So being freaked out, anxious, there's a level where that's unhealthy, but being chill about a potential step up in audit increases is the wrong reaction. So I actually think that you do have the correct reaction. Okay. And then the question is, how are you going to channel that anxiety? Because if you do nothing, then now you're creating additional anxiety for yourself, and it's just going to sit there and you're going to lose sleep at night. But if you take that anxiety and you say, okay, I'm going to make sure that my documentation is tight. I'm going to make sure that the tax positions that we've taken on my tax return make sense, that they're supported with citations. I'm going to have my CPA write, or I'm going to write a little narrative about it, because in 3 years, I can get audited on this tax return, right? And I don't want to be stuck in 3 years in the middle of an audit, not being able to explain why we took deductions in one way or the other. So I think that the appropriate action for everybody to take, assuming that this bill passes, there's still potential that it won't pass, but assuming that this bill passes, we're going to be reaching out to our clients saying, hey, we want to get a meeting on the books to really go over your situation and make sure that all of our T's are crossed, all of our I's are dotted, that we didn't miss anything, that you didn't miss anything, that we can put like a little narrative together about why we're claiming these rental losses against your W-2 income, that type of thing, so that when that time comes, we're ready, right? We want to win the audits. Audits don't have to be painful. They're painful for people that are not ready for the audits. Okay. So when that audit comes, you have a certain amount of time to respond, but you really have to drop everything and respond. I mean, you got to take time off work because they don't care. You have to get whatever documentation you need. You have to answer all the questions timely. If you want a no change audit, which is what you want, you don't want to have any tax changes. So to set yourself up for that, you need to sit down and document things today. You need to look back through your situation today. And if this bill passes, I would expect audits to start ramping up Q3, Q4, 2022. But they can go back 3 years, right? So we're not just talking about 2021, we're talking about 2020, 2019. So you got to go back and look at those tax returns as well. And you just want to do it with the help of a competent CPA.
So the other thing that's coming up for me as you are sharing this, things that are unknown create more anxiety because it's a big black hole, and then my brain fills it in with everything terrible. Practically speaking, if I was audited, I mean, do I get a telephone call from the IRS? Do I get an email from them? I get a bunch of spam from people saying it's the IRS, right? And all this stuff. But like, what does that practically look like for someone? And when you say you need to take off work, you need to be answering all these questions, like, do I need to be able to answer all these questions? Does my CPA get involved with answering questions on my behalf? Fill in some more of the big black hole for me.
Yeah, good question. So you'll get a letter that will initiate the audit, and it will tell you what years that are being audited, what tax years are being audited, as well as specifically what is being questioned. So it might be like Schedule E tax losses, or it might be a partnership interest that you wrote off as worthless or something. So they're typically not going to hit your entire tax return because it doesn't make enough money for them. Like it's not fiscally responsible for them. So they're going to look at specific things, typically Schedule C, Schedule E, that type of thing. And they're going to have specific questions that you're going to have to respond to throughout the audit. And yeah, you would typically work with a CPA or a tax attorney. They would filter through the auditor's questions, and you would not talk to the auditor. You do not want to talk to the auditor if you can avoid it. Typically, when taxpayers do that, they end up expanding the scope of the audit unintentionally, and then you end up with multiple years, multiple schedules. So you want to stick to working with a CPA or an attorney that has done this a few times and kind of knows their ins and knows their way around it.
That's very helpful. And is there if I'm audited and I come to your firm and say, help me through this, what sort of fees does that get into? Is there like a flat audit assistance fee, or is that an hourly thing depending on the complexity?
Yeah, most of the time we do hourly, just because the complexity levels can vary greatly. But if it's something that is relatively simple, like a Schedule A, adjustment or something, that's something that we might fix price. But most of the ones that we help with, we help with hourly. Okay. And you'll probably find that in the space as well, unless like we don't have a specific tax resolution arm where we're just churning audits out all day long. I'm sure if we had something like that, we would probably fix price all of our engagements. But there are firms out there that will do that will fix price your engagement. And you don't have to work with your CPA that prepared your tax return, but you don't have to work with them on the audit either. And sometimes that's not the best bet. Like sometimes we prepare tax returns, clients get audited. Like we just have one right now that we're assisting with, and we're sitting there looking at it like we're not the best person to help with this type of thing. We actually need to rope a tax attorney in. Okay. So it's helpful if your CPA has that awareness. But also helpful if you ask that question: are you the best person to help me with this audit? And how many have you done? And it's okay if you tell me that you're not, because I need somebody that's going to be really experienced in this particular issue to get me across the finish line.
That is all super helpful. And if this bill passes, maybe you'll get to start the resolution arm of your business.
Yeah, there you go. Yeah, we'll see. Yeah, tax resolution is fun. I like going toe to toe with the IRS, especially on Section 469 issues. So,
you might be the only person ever that I meet who says it is fun.
Now I need to know what 469 issue is.
Section 469 is the passive activity loss section. That's where you find real estate professional status and all that stuff. And typically when we have Section 469 audits, it's on real estate professional status, and we're trying to tell the IRS that these hours count, and they're trying to tell us that they don't count. So that's where we do battle. But yeah,
fight the power. I love it. Yeah. Man, I gotta hire Brandon. This is great. I don't know if that came up on my mic. I'm whispering, I gotta hire Brandon. This is great. I'll say it loud. So Brandon, let's do some clickbaity stuff here. And everyone loves top 10 lists, but I'm not going to go top 10 because we've already taken a lot of your time. Can you give us, let's say Joe Schmo and I have, let's say two scenarios. I am brand new to real estate investing. I just read all the real estate books. I listened to the podcast. I'm stoked about it. I want to get started, but I'm scared of taxes. And I'm Joe Schmo investor. I have 3 properties in Cincinnati, and I don't need a Brandon Hall experienced CPA. From a tax perspective, give us the scenarios for those guys. Top 3 things they should keep in mind tax-wise, or strategies they can use to get started in real estate and make sure they're protected.
So the first thing that any real estate investor should do is understand how Section 469 of the Internal Revenue Code works. That's the passive activity loss section. Yep, that's the passive activity loss section, because what that section tells you is that every single dollar that you earn, W-2, business, capital gain income, interest, dividends, rental real estate, whatever, every single dollar that you earn goes into either the passive bucket or the non-passive bucket. And your rental real estate by default goes into the passive bucket. Your W-2 income, business income, interest, dividends, capital gain, that all goes into the non-passive bucket. The problem that creates is that our rental real estate, because it's not in the non-passive bucket, any losses that I create from my rental real estate will not offset my other income, my W-2 income, my business income, my interest income. It just gets stuck and it gets suspended and it gets carried forward. So it's stuck in this passive bucket. These passive losses get suspended. So the very first thing to do for anybody out there is to understand that code section, because once you understand that code section, then you can start, and you don't have to like literally know the code, but just like get a 20-minute or get on a 20-minute presentation where somebody's going. We do presentations on this like once a month. So get on a presentation where somebody's talking about it, and it's going to break it down for you so that you can understand like how your rental real estate tax losses are treated, because then you have a bunch of questions that you can answer, right? Should I get a cost segregation study done? A cost segregation study accelerates bonus depreciation, which creates large tax losses. Well, if it's going to create a large passive tax loss and I don't have other passive income to offset that passive loss, then that large passive tax loss is going to get suspended and carried forward. I'm not going to be able to use it to offset my W-2 income or my business income or anything else. There's nothing that I can do because it's stuck in the passive bucket. So that's the first step, is understanding passive activity losses. And then it's answering this question. Should I do a cost segregation study? I just replaced the roof of my building. Should I do a partial asset disposition, right off the old roof that no longer exists, that I ripped out? The old roof had value. If I don't write it off, then I'm still depreciating it, but I only have one roof. But now I'm depreciating two roofs if I don't write the old one off that no longer exists. That's called a partial asset disposition. So it's paying attention to your rehab schedules and making sure that you're really being intentional about this, because the tax code is going to reward you. If you're good at documentation and if you're good at asking the right questions, the tax code is going to reward you. You can't rely on your CPA to do this. And I tell our clients, you can't even rely on us to do this, because the reality is that in March and April, we have to prepare 400 tax returns. And that is a massive task. Now, we're pretty good at it, but that's still a massive task. So I want all of our clients to be educated on the various things that they can do. So your guys with 3 rental properties, the first thing that I would want to know is, do you have W-2 jobs? What are you doing outside of rental real estate? And if you do, then the rentals are most likely going to be passive. So now I know I'm not going to do a cost segregation study. Now I know I'm not going to try to juice the tax losses. There might be some timing things. So maybe I'm saying, well, what are you trying to do next year or the year after that or 5 years from now? Are you still going to be working at your W-2 job, or do you plan to retire? Maybe they say, I want to buy 7 more properties and I want to retire by 2023. And I would say, cool, we're not going to cost seg any of your properties. When you retire in 2023, we'll cost seg all of them at that point. And what we'll do is we'll retroactively claim all the depreciation that we've missed. We'll claim that depreciation in 2023. So in 2023, you're going to have like a $500,000 tax loss, and you'll be able to wipe out any income. You can roll over your IRAs at that point. You can cash out your 401ks, because all that income will be able to offset with these rental tax losses. So it starts getting really strategic like that. But it's understanding the passive activity loss rules. It's asking the right questions, understanding the timeline, the goals. Are we in acquisition mode? How much are we acquiring? When are we potentially leaving our W-2 job? And then it's just matching that up with the timeline of claiming the tax losses.
Man, that I am like 0 for 10. Like everything you just said, I'm like, I don't know, Brandon. That's such good advice. Like I need to think about, I have like a legal pad here that I'm just like filling out things Tim needs to do to figure out this stuff. Cost seg and real estate activity and stuff like that.
You need somebody that's going to guide you through the process. And and that's what we do on our planning, or we try to do on our planning. But a lot of CPAs struggle with that. They're just compliance. They're very good at compliance, but they're just compliance. Yeah. And so if that's the CPA you're working with, that relationship looks like I meet them once a year to give them documentation. Then I receive my tax return and I sign it. That's a compliance CPA. And those are very valuable CPAs if you use them correctly. But if you're expecting that CPA to ask you the right questions, to do everything that we're talking about right here, then you're going to be disappointed. So then it's on you to hold them accountable to it by asking them the right questions, to get them thinking about it and then coaching you on it. Because most of the CPAs like roughly know their passive activity loss rules. I mean, a lot of CPAs I have found don't know the nuances, but they roughly can guide you, which is fine for young portfolios. So, but you have the ultimate accountability. So, and that's what we've been trying to do with that Tax Smart Investor group, is recognizing that, hey, look, like people aren't going to come pay us $4,000, $5,000, $6,000 for this tax planning, but they still need to understand what questions to ask. So let's try to create this resource for them to come to and learn, so that they can go back and ask their CPAs for the citations, for the right questions to help to get their CPAs thinking.
Yeah. I love it. That is such golden advice. And yeah, I think everyone check out that Facebook group. We'll link to it in the show notes,
Thanks.
to the Facebook. What was it called?
Tax Smart Real Estate Investors.
Tax Smart Investors. Sorry,
Yeah,
I couldn't even see my notes.
Facebook.com/groups/Tax Smart Investors.
Yeah, I think that's awesome. I appreciate that resource too. I'm a big fan of business owners that give content for free, answer questions for free, just provide resources for people, because we're all in this game together. I mean, there's a whole abundance mindset of, some people kind of see real estate as, I can't share these deals because there's only so much deals to go around and stuff like that. But there's enough for everybody. And I think it's a group game, and I think it's a network business. And, just you guys providing that information on the Facebook page is priceless, because I've learned so much today just on this hour-long podcast, Lisa.
Yeah. And
you know more than I do, because you already work with these guys. But
well, and I would just say, Brandon, I mean, my husband was an economics major, so he knows a lot more about taxes and whatnot than I do. But for both of us, we learned so much. So the education piece that you and your team provide it's hard to put a price tag on that, right? Because there's long-term benefits to that for us and our portfolio. And yeah, so I just want to highlight how excellent the education is that your team and you offer. And it is really helpful to sit with people who are like, you guys know it inside and out. And so I came to the conversations feeling like I know nothing. I'm going to be, sound like a complete idiot. And yet it was totally fine. Like it was okay that I showed up really knowing nothing. And I don't know near what I need to know, but I know way more than I did before working with you guys. So there's just a lot of value that you're providing, and I'm grateful.
I appreciate that. Yeah. I mean, like over time, again, as our firm has grown and we've had people successes and people failures and client experience successes and client experience failures, the one constant that I've realized is, if all of our clients are educated on this stuff, they don't have to be technical experts, but if they know what questions to ask, at the very least, they can hold us accountable to good quality. Yeah. And that's really what we're trying to drive, is making sure that one, you understand it so that you're not like pushing some envelope that we really should not be touching because it's going to be a bomb when you're audited or something. But two, so that you can look at your tax return and ask good questions to our team to hold us accountable to preparing good quality tax returns. And a lot of folks in the industry just kind of, they'll send a tax return off, and if you have questions and pushback, they'll just say, just sign it, dude. And it's like, well, that's not how we want to operate. We'd rather have the dialogue, but in order to have the dialogue, you've got to educate your base on how to have the dialogue. So that's part of it too. But I appreciate that. And and that's our larger mission too. So you don't have to be a client of our firm to get that. You just come find us online, and we'll help you out.
Well, and I will just say this, the other piece that I really appreciate hearing you talk about today is your focus on the people. And it sounds like both the people inside the firm, your team, and also your clients. And as a CPA firm, you don't have to do that, right? Like, we need CPAs. Like, we're reliant on you, whether you provide good service or not. And so I think that's why a lot of CPAs can get it. Like, CPA that I've worked with does a great job on my taxes and whatnot, but I've tried to set up, can we talk to you before, tax season? And crickets, nothing. They don't want to talk outside of tax season. and they don't have to, right? Because I still need them. So I especially appreciate that focus on people, both inside and external to, your team, because you don't have to do that. You're still going to have clients that come to you. So the fact that you do it makes it all the better.
I appreciate you bringing that up, because that was actually one of the things that we had talked about with that I talked about with my partners when we were kind of designing our 2022 strategy. Because the reality is that CPAs don't have to do that. But I don't have to sit here and try to figure out how to make your client experience amazing. You can complain all day online. You could leave me 1-star reviews, and guess what? People are still going to reach out to me. because they're not going to see Google. They're just going to see CPA. I'm going to be at a dinner party with CPAs are the talk of the party at dinner parties. You know, if you get in the right dinner party, you're talking taxes all night long, and people love that. People love that.
Is that the right dinner party, Brandon? Is that the right dinner party?
Those are the dinner parties I go to. I don't know. Maybe I'm going to the wrong dinner parties. But yeah, you're totally right, Lisa. Like you don't have to. And what we also realize is that there are very few firms that actually try to figure this out. And we've always been trying to figure it out, but now I think that we've actually figured out the secret sauce to making clients really happy. And we're going to see how it goes in 2022. So I've got my fingers crossed. But you know, we bought this survey that they do a survey of like 400 CPA firms from various sizes across the United States. And so we got a benchmark profit margin across the United States for all these firms in our peer group, and then the next level and the next level as well. And what we're doing is we're taking that profit margin and we're discounting it 10%. So we're going to take less than our peers. And we're going to use that gap to go over hire people that we don't need necessarily. We don't necessarily need, you know, and we're going to staff our capacity a little bit better and provide people with more support, because we're going to have more people on the team than our competitors are going to have relative to the number of clients. So that's the ultimate idea, is to basically have more people servicing the same book of clients that the CPA firm down the road would have. And yes, that hurts my personal profit margin, but I also believe that that's going to take us to a $10 million, $20 million, $30 million CPA firm much faster than our competitor would ever get there. And I think we're going to have happier clients as a result. And honestly, like in my mindset, you know, it used to be all finance. Like we talked about reducing the financial risk at the beginning and trying to make enough money and all that stuff. And my mindset's kind of shifted to this, like, you know, I've got a house, I've got a car, I have 2 kids. Anything that I want to buy, I can go buy. It's like, it's not as motivating anymore to go and earn the next $100,000. But what is motivating is to be able to look at my staff and say, I can make all of you successful, however they define success, right? I can ask them what that looks like, and I can make them successful. I can bring them along with this journey. And I can look at all of our clients and say, all of you love our services. That is way more motivating for me now than trying to squeeze the next 5% of profit margin out. So we're doing this big mental shift at the firm right now. And I'm really excited, because I think that, Lisa, I think you're totally right. CPA firms don't have to do it. And CPA firms, they're lazy. They don't do it. And what we're trying to do is say, all right, well, let's build the model firm. Let's show them how it's done. And then they can just copy the blueprint later. That's fine. But let's see if we can do this a little bit differently.
I love it.
Man, I love that. And I hope everyone copies that blueprint. That is exciting news.
I hope it works. Otherwise, this is just a bunch of talk, right?
Right. But at least you're talking. At least you're trying. Yeah, that's the step one, right? Well, Brandon, thanks. You've been so generous with your time, and we could talk taxes with you forever. But I think, you know, if you'd be kind enough to come back on at some point next year, probably not March or April, I'm assuming, but you know, maybe after that.
Sure.
During the brief lull next year after the tax season. We'd love to have you back and talk more strategies and stuff like that.
You'll have to ask me what our client net promoter score is whenever we get back.
Net promoter score. Gotcha. Yep. Client net promoter score.
That's where we're aiming for an 8. Aiming for an 8 out of 10.
Nice.
Got it. We will ask. I'm making a note here.
Yeah. Hold me accountable to it.
All right, cool. Love it. Brandon, thanks so much. Lisa, do you want to land this plane, as you so nicely put it? Lisa takes us out much better than I do, so I'll just throw it back her way.
No, Brandon, thank you so much for your time and for sharing. And we're going to include links to the resources that you mentioned in your firm, your podcast. And thank you so much for the work that you do through the Real Estate CPA Firm, and also for so much you give away. It is incredibly valuable. Yeah. And especially for people that are just getting started out and may not have the capital to invest in the services. And we really appreciate that.
I appreciate that. Thanks for having me on, Lisa and Tim. It was a real pleasure.
Thanks so much for listening to today's episode of the REI Concierge podcast. We would love it if you shared this with about 17 of your best friends, or even your not best friends. Share it with everybody.
Strangers. Share with strangers.
Take some time to leave us a review. We appreciate that very much. So until next time.
Happy real estate adventures.